It's been a rough week for investors on Wall Street. The Dow and the Nasdaq both falling more than 2 percentage points today. Some of this comes from a spike in unemployment, now rising for the 4th straight month. To dig into some of the facts, let's bring in Michael Armstrong. He's the president of the Armstrong Advisory Group. Thanks for joining us, Mike, live on CBS News Boston. Now, all of this turmoil has a lot of folks thinking that maybe we're heading for a recession. Are you seeing that with the unemployment numbers coming out now?
Well, that's certainly the new concern. It's not too long ago, 6 months, a year ago, where the primary concern was really about inflation and whether or not the Federal Reserve could get it under control. Those concerns seem to have passed, not insofar as prices going back to 2019 levels, but merely the idea of inflation continuing at this point seems in the rearview mirror, and now all eyes on that unemployment scenario that you mentioned, with the unemployment rate now climbing to 4.3% as of this morning's report from the Bureau of Labor Statistics.
So does that mean that's the end of the bull market as far as you're concerned, seeing what you're seeing now on Wall Street?
No, I think this is certainly a repricing in today's markets, and I don't think that's terribly surprising. But as any economist will tell you, this is no certain thing that we are in for a recession at this point in time. What a lot of people today are referring to is something called the Sahm rule. It's named after a former Federal Reserve economist, Claudia Sahm, who looked back at data and found that when the unemployment rate climbs by 0.5% or more in less than 12 months, it's historically been a pretty good indicator of recession. So I think that's what people are concerned about. That having been said, she'd be the first person to admit that it doesn't mean that it's going to be immediate, nor does it mean that it necessarily indicates the same thing that it used to. I could list a number of different recession indicators that used to be really reliable pre-COVID. And you have to just admit and understand that, the shutdowns from a few years ago, combined with the massive spending increases over the last few years, have distorted a lot of the previous economic indicators we used to use.
Yeah, that's really interesting. And I guess that a lot of folks haven't taken that into consideration. But one of the things that most people are talking about are their 401ks. What does all of this mean for the average person?
Well, for the average person, that 401k is going to be down after today. Certainly there are some of us who might have it all in some sort of fixed investment that's not exposed to equities, but, pretty globally at the moment, whether it's, Japanese equities or US equities, we're seeing things come down dramatically in a repricing of this new risk. On the other hand, in the bond market, you're seeing bonds rally, which is pretty typical when people are concerned about recession. What that's doing is bringing the interest rate down on, really the entire yield curve, but you're seeing that expressed today on the 10-year Treasury bond, with that coming down to about 3. Pretty clear benchmark and driver of everyday interest rates that Americans face, whether it's through their mortgage or an auto loan or business loans, oftentimes driven in part by that 10-year Treasury yield rather than what the Federal Reserve is doing on a month-to-month basis.
Speaking of, the Federal Reserve and talking about interest rates, and folks are wondering, when are we going to see the interest rates drop? Do you have any insight on that?
Well, the Fed has pretty much all but guaranteed a rate cut in the September meeting. I think the question now after this unemployment report is, will it be a mere 0.25%, or will they do something more like a 0.5% rate cut? But that meeting doesn't come until September 30th. There is a symposium going on in Jackson Hole in a few weeks, and so I think the Federal Reserve could be very transparent and clear that they think they will will lower rates in that September meeting. And remember that the Federal Reserve really controls just that Fed funds rate, not the rate that you pay on your mortgage or your auto loans. Those are all market driven, and we're already seeing those come down. I looked this morning. According to Mortgage News Daily, the 30-year fixed rate mortgage that they're seeing now is sitting at 6.4%, and it was not very long ago that was up over 7%.
Yeah, that's definitely a big change. One of the other things that a lot of folks are also talking about are tech stocks. How much did the tech stocks, or do the tech stocks have anything to do with what's happening now on Wall Street?
Well, it's been a big week for earnings from major tech companies. You had Microsoft, Meta, Facebook's parent company, Amazon, and Apple all reporting earnings just this week. Honestly, it was a mixed bag. It was not all bad news from those companies, but those have, the Nasdaq in general as an index has been a large driver of the positive returns that you have seen this year. And there are many companies in the S&P 500 that have not fared as quite as well, but people's 401ks, like you mentioned, might have held up just purely because of those magnificent seven stocks. It was a mixed bag, like I said. I think there's some very high expectations for those companies in terms of their earnings growth, especially anyone connected to the artificial intelligence semiconductor space. And they need to continue to deliver on that if their stock prices aren't going to be punished. And like I said, I think what you're seeing today is a bit of a repricing with that new expectation that, hey, recession may be what is coming instead of that soft landing that the Federal Reserve and frankly all of us were hoping for. And quite honestly, I don't think it's going to take long to know. Right? Within the next few months, we will know should the unemployment rate continue to tick up. We even get weekly reports on the state of the job market via the unemployment claims that come in every week. So should those start ticking up, should more people hang out on unemployment for longer, those are all indicators that, hey, this unemployment situation could be worsening. It's also possible it flatlines here, and in which case, if we have an economy that's showing low 2 to 3% inflation with unemployment in the 4.3% range, that's not a bad economy. It's just the trend line has been upwards on unemployment, and I think that's what's spooking people today. With
any of this, does this have anything to do with the upcoming election? Do you see anything here that's indicating people are jockeying for position or that Wall Street's signaling anything?
I really don't see much there. I think it's traditionally and historically extraordinarily difficult to predict how the markets are going to react or interpret anything on the political side of things. One thing I will acknowledge, though, is the last 5 weeks have been historically volatile on the political scene. And so, if you told me that, hey, investors have a little bit more jitters in their system just because of what's been going on between the assassination attempt of Donald Trump, the very poor debate performance from Joe Biden, then the subsequent, pulling out of the race of Joe Biden, and now Kamala Harris being the Democrat ticket. All of those things may be contributing to some of the jitters, but really, I think today was genuinely just about that recession risk, and trying to read too much into other areas might lead you down the wrong path.
Well, a lot to think about and a lot to watch in the coming months for sure. Thank you so much, Michael Armstrong with the Armstrong Advisory Group.
Thank you.